School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 5 Emerging Issues in Accounting, Unit 16 Forensic Accounting, Part-2.
Application of forensic accounting. Fraud detection and prevention is one of the principal areas in which we find the application of forensic accounting. But the scope of forensic accounting has increased in recent years. Some of the specific practice areas of application for forensic accounting are: number 1, bankruptcy, insolvency, and reorganization. The services of the forensic accountant can be availed by debtors, individuals, or organizations contemplating bankruptcy or already in bankruptcy, and creditors. In bankruptcy cases, forensic auditors mainly perform business valuations to resolve bankruptcy filing. They often work towards corroborating and supporting both the disclosure and the claims. At the operational level, they assist the trustee in managing the financial affairs, identifying pre-bankruptcy transactions, searching for hidden assets, and recovering hidden funds and assets. Creditors also use their services for the same purpose mentioned so far, to increase the quantum of recovery. Number 2, computer forensic analysis. Nowadays, most of the transactions are done electronically, and information regarding these can be found in files stored on location beyond the computer infrastructure of the parties involved in the transaction. The role of a forensic accountant is to recover and preserve this information for evidence purposes and litigation support. The competency of forensic accounting lies in knowing the type of electronic information that may exist, the form and format in which it is stored, the location of the information, and the means to access the information. Number 3, economic damage calculations. When two or more parties are involved in a transaction and action or inaction of one of the parties causes loss or injury to the other party, damages arise. Damages can be in the form of lost earnings, lost profit, or physical loss of property. Forensic accountants are often for damage calculation as well as for reviewing and refuting damage calculation by the opposing party. They also help in reaching a negotiated settlement of damages instead of going for litigation. Number 4, family law. Forensic accountants can have several roles in cases involving inheritance, will, Hindu undivided family, that is HUF, and marital dissolution, that is divorce and past divorce. In cases involving inheritance, will, and Hindu undivided family, the documentation is often not adequate and claims of individuals are often entangled with the claims of other individuals. Forensic accountants are often called to uncover hidden or undisclosed sources of income or assets, entangle the claims, and reach fair valuation of assets to satisfy the claims of parties involved. In case of marital dissolution, for the purpose of determining alimony and child support, the earnings and expenses of each party has to be evaluated along with the earning potential. This can be effectively done by the forensic accountant. Number 5, financial statement misrepresentation. The statutory auditors examine the financial statements and determine whether the financial statements properly report the balances, results, and required disclosures. If the internal or statutory auditors flag any issue such as overstatement, understatement, omission, and improper accounting treatment, then the forensic accountant's role comes into play. They calculate the effect such identified issues would have on financial statements and determine the persons and process for these improprieties. They will also uncover if there was any underlying scheme or motive for misrepresentation. Number 6. Fraud prevention, detection and response. This area has the most prominent role for forensic accountants. They design the accounting and control systems to prevent frauds, investigate frauds that have occurred, and redesign the system with better controls and procedures to prevent reoccurrence of frauds in the same firm or potentially any other firm. Their services can be used to proactively evaluate internal control systems, financial policies, and accounting procedures. Business valuations. Services of forensic accountants are used to conduct business valuation in a number of contents. The valuation may be required when a partnership firm is dissolved or one partner is leaving or buying the interest of the other partners. In case of bankruptcy, the creditors have to be paid out of the remaining assets of the bankrupt firm. The remaining assets are valued by the forensic accountant. Similarly, in case of NPAs, the banks have to have a haircut, with receive rupees 10, 20, 30, 40, 50 or 60 instead of rupees 100, which was originally due from the borrower. To decide the quantum of haircut, the expertise of a forensic accountant can be used. Nowadays, startup companies are becoming a part of our economic ecosystem. A venture capitalist invests in these startup companies based on valuation derived in part by forensic accountants. Types of frauds. The origin of the fraud can be either internal or external. Frauds perpetrated by employees and owners are referred to as internal frauds, whereas frauds committed by outsiders who are not employees or owners is referred to as external frauds. The asset misappropriation chart listing most of the probable frauds is often referred to as fraud tree, the reason being the numerous ways in which the frauds can take place represented by branches of tree. As per the fraud tree classification, asset misappropriation is subdivided into cash misappropriation and inventory and all other asset misappropriation. Cash misappropriation is the most common and consists of many ways. Fraud involves an intentional deception by the individual's associations with the business in their capacity as employees, owners, vendors, customers, and anyone else related to the business or unrelated to the business in order to inappropriation to obtain money or services or any asset leading to financial loss to the business. Some of the frauds are standalone frauds committed only once, whereas some are perpetrated over a period of time. Frauds can be committed by an individual alone or in collusion with other individuals or entities. An extensive classification of frauds is done by the Institute of Fraud Examiners and is popularly known as the fraud tree. Fraud origin and accounting cycles. In order to understand the genesis of fraud and how it perpetuated, let us briefly discuss the 5 accounting cycles which are common to the manufacturing and trading business. These cycles are: Number 1. Sales and collections or receipt cycle. Number 2. Purchase and payments or disbursement. Number 3. Personnel and payroll. Number 4. Inventory and warehousing. And number 5. Monthly reconciliations and reporting. Sales and collections or receipt cycle. Sales and collection cycle consists of making sales and collection of sales proceeds either immediately in case of cash sales or after a period of some time depending upon the credit policy of the firm. This cycle is the most cash incentive cycle out of the 5 cycles and most prone to frauds as the employees may have access to and opportunity to divert customer payments in the absence of proper internal control. In the fraud tree classification, the frauds which can play in this cycle are larceny, skimming, check tampering, and register disbursement. In addition, frauds can occur through front-end frauds also in this cycle. The common ways in which frauds occur in this cycle are thefts of cash on hand. It includes number 1, employee steals the cash outrightly. Number 2, employee uses the cash for his personal use for a period of time and replaces the same at the time of reconciliation or make good the shortfall through a fictitious book entry. Theft of cash receipts. Thefts of cash receipts can be done by skimming and larceny. Skimming is the process by which cash is removed from the business before a formal entry of the cash is made in the accounting records. This is an off-book scheme because the cash receipt is neither reported nor entered in books of accounts. The common skimming schemes are number 1, sales scheme. It includes unrecorded sales and understated sales. Number 2, account receivables scheme. It includes write-off schemes, lapping schemes, and unconcealed receivables. And number 3 is refund and other schemes. Under the skimming sales scheme, the sales are either unrecorded or understated. This is true for businesses where the primary mode of transaction is cash. Detection of theft of cash receipt schemes include number 1, analyze cash receipts and their recording. Number 2, analyze deposit slip book. Number 3, analyze sales account by an employee. Number 4, analyze the gap between receipts from customers and the date the payments are posted on the customer's account. And number 5, review entries in the books regarding credit to inventory account to conceal unrecorded or understated sales, writing off inventory due to lost, stolen, or obsolete product, and writing off accounts receivable. Also, one can analyze the relationship between sales and cost of sales, sales and sales return, and allowances on sales. Purchase and payments disbursement cycle. This cycle starts with purchasing of goods and services required by the organization and ends with payments for these goods and services. Through this cycle, many can operate, resulting in fraud. An individual working with the purchasing department may perpetrate fraud by setting up a shell company to receive goods misdirected from the company by false invoices. In case where processing and approving duties are segregated, individuals can collude to perpetrate fraud. The procurement fraud is generally a collusive employee-vendor scheme. The employee will receive a part of gains accruing to the vendor by substituting products inferior to contract specification, billing for work not computed, shipping user quantities more than contracted, or padding overhead expenses. Another common scheme is to raise an overvalued invoice by the vendor and get it processed by the employee. Personnel and payroll cycle. This cycle starts with the hiring of the employee, maintaining and terminating employees. The main activities involved in the personnel and payroll cycle is determining salary and benefit amount, monitoring and approving employees' expenses and reimbursement, and all other aspects relating to compensation of employees. The typical fraud schemes perpetrated in this cycle are number 1, payroll schemes. Number 2, ghost employees. Number 3, commission schemes. Number 4, workers' compensation fraud. Number 5, falsified wages scheme. And number 6, expense reimbursement scheme. Ghost employees fraud occurs when non-existent employees or employees who have left the organization are added to the payrolls and their wages are received by another employee or group of employees who have colluded to perpetrate the fraud. This kind of fraud is most likely to occur in large organizations with many employees coupled with weak internal controls. This fraud may also occur at remote work sites like mines, dams, railways, etc. Commission schemes are most likely committed by sales employees or employees whose remuneration is dependent on achieving certain targets. To perpetuate this kind of fraud, the employee either manipulates the target to be achieved or gives an impression of the target being achieved. For example, to achieve sales target to receive a commission, sales personnel may execute a bulk of sales on a credit basis, which later turns into either bad debts or sales returns. Another variant of this scheme is the dumping of products in another sales territory for which someone else is responsible. Dumping is usually executed by offering huge discounts and is another form of revenue loss. Workers' compensation fraud is committed by falsifying injuries and attributing them to work conditions in order to extract insurance claims or compensation from insurance companies or employers. Falsified wages scheme involve employees claiming remunerations for hours not worked and includes falsifying of timesheets and time cards. An expense reimbursement scheme involves claiming false expenses. These kinds of schemes are of four types, viz. Mischaracterized expenses, overstated expenses, fictitious expenses, and multiple expenses. Out-of-pocket expenses related to the business are reimbursable, like travel, lodging, and meals. These expenses, when not done for business purpose but still claimed as business expenses, are referred to as mischaracterized expenses. In an overstated expense reimbursement scheme, inflated bills are submitted by modifying expense receipts. Other methods include overpurchasing and benefiting from refunds and discounts. Sometimes the employee in whose name expenses are to be reimbursed may not be involved. However, the person processing the reimbursement may insert a false claim and process it and pay the actual amount requested to the employee and pocket the extra expense which was inserted fraudulently. In a fictitious reimbursement scheme, an employee requests reimbursement for wholly fictitious expense. In case of multiple reimbursements, employee requests reimbursement for the same expense multiple times by submitting claims to different authorities. Fraudulent financial reporting schemes. Over-reporting and under-reporting of revenues are the two methods used by the business depending upon the motivation of the people running the business. Under-reporting is generally resorted by sole proprietorship firms, partnership firms, and private limited companies with a motive to evade taxes like GST. Previously, this constituted of excise duty, sales tax, value-added tax, and various other taxes, and income tax. Overstatement of revenues may not strictly be treated as fraud, but it does distort a company's true financial performance in order to exhibit the desired result. Principles governing recording of revenues are not rigid, and flexibility is always allowed. When this flexibility is exploited to distort the true picture of the company, revenue reporting abuses occur. Financial statement frauds would improperly reflect one or more of the basic accounting elements, viz. Assets, liabilities, equity, income, and expense. Since modern-day accounting is based on double-entry bookkeeping, misstatement will result in two or more of these basic elements being misstated. The different methods that are used for overstating revenues are: number 1, accelerating shipments; number 2, keeping books open in order to record sales often made at the end of the accounting period; number 3, recognizing transactions as sales which are not yet sales. Examples include consignment sales not yet sold to the end user, sales with a special condition, certain file and whole transactions, products shipped for trial or evaluation purpose. Number 4, swaps or round-trip trades and related party transactions. Number 5, non-adjustment in gross sales by understatement of returns, discounts, and markdowns. And number 6, fictitious sales. Revenue recognition detection techniques. Variety of techniques can be used to detect anomalies in the revenue recognition process. ranging from inquiry and analytical test. Some of these techniques are: number 1. Seek information from the marketing, sales, and finance department. Analyze how and when revenue targets were achieved and critically analyze the sales that occurred near the end of the accounting period. Number 2. Through cutoff testing, determine whether sales were accelerated or decelerated. This can be found out by examining purchase orders, invoices, and shipping documents, comparing the billed volumes with shipping volumes, analyzing ending inventory, examining documents for pre- and post-dating, examining logistics and warehousing documents, looking for large shipments near the period end, significant returns, and bill and hold transactions. Number 3. Analyze large transactions near the end of an accounting period with a new customer or with a related party. Number 4. Analyze new customers making large purchases. Number 5. Confirm physical location of purchasing entity. Number 6. Review transactions after the closure of the accounting period for evidence of invoicing and payment or cancellation or return of goods. And number 7. Seek confirmation from customers regarding volumes, amount, dates, and side agreements and pay. Improper revenue recognitions. Side agreements. Sales is often made on pre-agreed terms and conditions and formalized in terms of the agreement. Managers and executives may modify, revoke, or amend the terms of the sale without proper authorization outside the recognized sales process or reporting channels. The common modifications include purchase return rights, extended credit period, refund, or exchange on return. These modifications may impact revenue recognitions, with there is a probability of advanced revenue recognitions if there is a purchase return. Round-trip transactions. Round-trip transactions are the transactions between two or more economic entities, and these transactions do not yield any business or economic benefit for the entities involved. The underlying motivation for entering into these transactions is to inflate the revenues or create an appearance of strong sales growth. Round-trip transactions may include two-way sales between two companies for the same amount within a short period of time, or it may involve a loan, advance, or investment in one entity so that the other entity can purchase goods from the company making loan or investment. Bill and hold. Under this scheme, the sale is recorded in books, but delivery and transfer of ownership have not yet occurred as on that date. Altering shipping documentation. Through a false shipping document, a company may falsely record sales, or by altering genuine shipping document, commonly altering dates or terms of payment, a company can inflate revenue in a specific accounting period instead of the subsequent accounting period. Agreement to sell through product. In this scheme, sale agreements include contingent terms which are based on the future performance of the buyer, that is, commonly distributors and resellers. To understand this, suppose company A sells to distributors B and C goods with the condition that B and C will make payment only when they have further sold the goods. Now company A books the sale the moment goods are transferred to B and C. This will increase the sales figures, though no actual sales have been made to customer or end user. These agreements are similar to consignment sales. A sale should not be recorded until the goods are sold to a third party with no additional contingent sales term. Upfront fees. Some sale transaction requires the customer to pay upfront consideration for services that would be provided over a period of time spanning over several accounting periods. In order to manipulate earnings, companies recognize these fees as soon as the transactions are entered into, and sometimes even indulge in falsification or modification of accounting records. A prudent approach in this case would be to recognize only the revenue for the services provided in the specific accounting period. Holding accounting periods open. Accounting periods are well defined under the various acts, but the companies, in order to show better results, keep the books open to include transactions that happen after the accounting period. This scheme commonly involves recording sales, cash receipts, etc. that occurs after the end of the reporting period. This scheme is often operated either by falsification or modification of accounting documents like the date on shipping documents, purchase orders, bank statements, cash reconciliations, cash receipts, journals, etc. Non-recording of sales provision or allowances. Some sales transactions include a provision of return of purchased goods by the purchaser. Companies shall create provisions for these kinds of transactions to reduce gross sales to account for future sales return. By failing to create provision for sales return, companies can overstate revenues. This scheme is operated by falsification or modification of documents on which accounting entries are made. Inventory schemes, inflating or deflating the value of inventory. Inventory valuation can be manipulated in a number of ways depending on the motive involved. If tax evasion avoidance is the motive, inventories would be undervalued. Inventories would be overvalued to show inventory gains, and if inventories are kept as collateral for bank loans, the motive would be to avail a higher loan amount. The common ways in which inventory value is manipulated are moving inventories between locations to fictitiously inflate or deflate inventory quantities, postponing or propounding and under or over-reporting of write-offs and reserves for obsolescence, manipulating unit valuation and improper inventory capitalization, off-site or fictitious inventory. Companies may create or destroy inventory by falsifying journal entries, receiving and shipping reports, purchase orders, and sales invoices. Companies indulge in these schemes to decrease or increase the cost of sales as a percentage of sales.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Vagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.